millions of raw components, thousands of labor hours, a massive moving assembly line transforming physical materials into finished goods. For an accountant, capturing that physical reality requires moving past single, isolated spreadsheets. The operating budget operates as a strict, interlocking mathematical system. The ultimate destination of this system is calculating the final gross margin for the pro forma income statement. But there is a mathematical blocker. You cannot accurately project gross margin without a precise cost of goods sold. And you cannot derive cost of goods sold without first mapping the exact costs embedded in finished goods inventory. Every calculation feeds the next in a sequential pipeline of 5 distinct stages. Input costs flow into unit cost, which values ending inventory, which defines cost of goods sold, which finally reveals gross margin. We are going to forensically track a single dollar of cost through this exact gap framework to see how it alters the final profit. Because this is a rigid pipeline, a single miscalculation at the raw input level will exponentially corrupt the final profitability metrics. The first node of our pipeline starts on the factory floor with the raw input of direct labor. Building a budget using standard base wage rates will leave your calculations dangerously incomplete. You have to incorporate mandatory additions, employee fringe benefits like FICA, health insurance, life insurance, and pension matching. This employee fringe benefit projection schedule shows how specific percentages inflate base wages. Adding the 4 fringe categories for June, the $67,850 in wages becomes a total projected direct labor cost of $87,358. Next, we convert this total pool into a single hourly rate by dividing the total labor cost by the total projected labor hours. This gives us our exact data point, a fully loaded direct labor cost of $24 per hour. Failing to capture fringe benefits right here fatally underestimates the variable manufacturing costs for the rest of the year. Now we shift from calculating raw inputs to valuing a single fully assembled finished unit. This step is governed by a strict external reporting mandate, absorption costing. Under absorption costing, all manufacturing costs, both variable and fixed, must be completely absorbed into the cost of the product. This table breaks down the unit cost calculation, allowing us to see absorption costing in practice. The exact labor output we just calculated becomes the direct input for the schedule. 2 hours of labor required per unit, multiplied by our $24 input cost, equals $48 of labor per finished unit. To fulfill the gap absorption requirement, fixed overhead costs are also injected into this list. We reach a final aggregated cost of $108.95 to produce one finished unit. The core implication of absorption costing is that because fixed costs are absorbed into the unit itself, they will sit as assets on the balance sheet until the product is physically sold. We now pivot to the end of the production cycle, calculating the value of units that were manufactured but remain unsold. We apply a first-in, first-out assumption. This means the units remaining at the end of June are valued using June-specific production costs. This equation shows the total value of the ending inventory, calculated by multiplying the finished unit cost by the projected remaining units. 200 remaining units at $108.95 creates an ending inventory value of $21,790. This is the cost of goods sold budget. To find the cost of what was actually sold, the ending inventory value must be subtracted from the total available goods. The inventory value we just calculated flows directly into the COGS formula as a deduction, which reveals our final cost of goods sold figure, $484,284. This is the culmination of the entire manufacturing cost pipeline. With COGS secured, we execute the final subtraction for the pro forma income statement. Sales revenue minus cost of goods sold yields a gross margin of $1,079,716. Cost of goods sold is the vital bridge connecting the physical reality of the factory floor with the financial reality of the income statement. The gross margin calculation we just completed satisfies external investors and strict GAAP requirements. But what is legally required for external reporting often actively obscures the exact data needed for internal operational decisions. For internal reporting, management relies on variable costing, a framework that strips fixed overhead out of the product cost entirely. This alternative framework produces the contribution margin, the amount of sales revenue left over after subtracting only the variable costs. Contribution margin is superior for internal reporting because it cleanly reveals how a change in production volume directly impacts profitability, without the noise of fixed factory costs. This graphic illustrates the break-even point, which connects directly to variable costing. Contribution margin pays down fixed costs until operating profit hits exactly zero. Every single dollar of sales achieved beyond this break-even point flows directly into operating profit. A modern management accountant must be effectively bilingual, speaking the rigid math of absorption costing for external compliance, while utilizing variable costing to guide internal strategy and survival.